And that should work too. So welcome back, everyone. First of all, congratulations to making it halfway the program. Uh, because we're already in week 5, I actually think it's a little bit weird when I think about it. It still feels like we just started. So, but the reality is we're basically halfway down. So last week we had a really fun session. At least that's what Wasim and I thought. So, and we also discussed a little bit what to do with like the discussion that we had last week. So we decided to shift around the program a little bit. We were supposed to talk about marketing and sales and technical implementation this week. But based on last week's that you shared about your own companies, we actually thought it might be better to move the whole fundraising and pitching part a little bit forward. Does not mean that we're scrapping the other sessions, but we'll probably do it just later in the program. So for this week and also next week, we're gonna do sessions on, I call them pitch drill. Pitch drill is a session that I, with the Startup Buddy, have been running already for a long time. We came up with them together with Vertex Ventures a long time ago when I was still based in the Cohort space in Singapore by Vertex Ventures. For those, maybe most of you don't know, Vertex Ventures is one of the oldest and also largest VC firms in Singapore. And it's a spin-off from Temasek Holding. For those who don't know Temasek Holding, Singapore basically has a sovereign wealth fund, or two actually. One is called GIC, the other one is called Temasek. And those two financial institutions are two of the big, I think they're somewhere in the top 10 biggest financial institutions on the planet. So they are a very major investor in general. And they are also a very major investor in startups through Vertex Ventures. So when I was working there, at some point it came up, we should have a way to tell entrepreneurs, especially new entrepreneurs, young entrepreneurs, more about how pitching works, how fundraising works, and to give them a little bit of context. And the way we decided to do that is to actually let entrepreneurs pitch to each other and give feedback to each other. It's a little bit similar to last week. So we'll do that today a little bit and a little bit more next week. The reason I feel this works well is because most entrepreneurs only pitch when they are in front of the investor. And that's usually too late. As in, most investors will not give you a lot of chances to pitch to them. Basically, you make a good impression or a bad impression, and if you make a bad impression, you probably spoiled the opportunity for that particular investor. So you actually want to do the practicing and learning before, not during. So that's why we did it this way. So this is the program for today. I'm going to tell you a little bit about fundraising. I do not really know where you guys are at in terms of your knowledge on this topic. So I've assumed you don't know much, but you can tell me if I'm too slow, if I'm too fast. But the assumption is you don't know that much. So I'll share a little bit about fundraising, why companies fundraise in the first place, because there is a reason for that, or there should be a reason for that. Then I'll share a little bit more about investors. The startups always talk about, I want to raise funding from VCs, but typically that's not the first person you go to, or you should go to make it successful. And then I want to go to the elevator pitch, which is the simplest and quickest pitch to learn. Next week, we will go further also into a pitch deck and what to look for and how to present that and things like that. Of course, you can ask questions anytime. I just like to ask you, try to keep your questions to the topic that I'm on. Everything else, I'm also happy to answer, but keep a little bit to the end, because I hope that if I do my job well, I cover most of the stuff that you want to know. So if I'm on a totally different topic, then please have a little bit patience till the end. So I have obviously already introduced myself a couple of weeks ago, and I'm not going to bore you with my whole resume for today. But I did want to show you this picture. I use it in other workshops too. This shows a little bit like how I got started building my company, the Startup Buddy, what my previous experience is, like companies that I worked at before. All of that I don't want to go into for today. But in this picture, there's also a couple of things that explain to you why I'm explaining you about fundraising and investing. The short reason is very simple. I've been investing since I was 12. I'm 47 now, so the majority of my lifetime. If you look at the top left corner for me, you see a picture of a guy playing a recorder in the US or a flute in the UK. That's me. I think I'm 11 in that picture. So a long time ago, basically, I was a street musician when I was very young. I read a book, which is a French book about a group of homeless kids in Paris. They go around the streets cleaning chimneys in the 1800s. And they also perform street arts in the streets of Paris, and that's how they survived. I read that book when I was 10 or 11, and in April every year in the Netherlands, where I'm from, we have a national day called King's Day. And it's normal on that day to go into the streets, sell all your secondhand stuff that you want to get rid of. But also a lot of people do like street arts, like music or other things. So I just read that book and I thought, let's try that out. And I did. And it turned out to be very, very successful. I made 12 guilders, which is equivalent now to something like 12 euros. Me in about an hour, me being 11 years old, that was a fortune. So from that moment on, I continued doing that. I've been doing that until I was about 17. At some point, I had a permit, and I've even been on national TV and stuff like that. Anyway, it doesn't really matter. But I saved up quite a lot of money for a boy that age. So at some point, I told my parents, okay, I'm going to buy a very, very big stereo. That got vetoed by my parents because they said, no, you're 14, doesn't make sense for you to buy a stereo for 1,000 guilders. The only reason I wanted that, I have a brother who's 9 years older. He had one, so I needed one too. That was my rationale, which I still think was very sound. But so my parents vetoed that. My father was at the time working in a company called CMG, which was a system integrator, which at the time was very big. And he basically told me, okay, you know what, we're going to buy you this very small transistor radio that you can do, but we're going to do something smarter with the rest. And I invested that in that company. That happened to be possible because he was working there. So that company turned out to IPO when I was 18. And all of a sudden I had a lot of money, especially for a guy that age. And that kind of got me further into investing. So you see a label there from, it should be there, TIN. Where's TIN? TIN, sorry, all the way. Yeah, TIN Capital. So TIN Capital is an angel network, an angel investors network in the Netherlands that I've been part of since I was 20. And I started investing basically as a hobby in companies there that were usually Series A, Series B type of companies, almost always in the software space, because that was what I understood the best. Later also I started working at Accenture. So I've always only invested in stuff that I understand. And I still do that, by the way. Like, I still don't understand cryptocurrency really well. So I don't invest in it either. I don't get the business model behind it. That's basically my rationale. So since then I've been investing for a long time. I'm now invested in quite a few VCs also. So I'm an investor in Our Crowd, which is the largest VC in Israel. And I'm an investor in Play Ventures, which is a gaming VC based out of Helsinki, but they also have offices in Singapore. So long story short, I have a little bit of experience doing this. Apart from that, since I started the Startup Buddy, I also try to educate myself on a little bit more academic level to make sure that I didn't just do everything on experience. So I've also, for example, done the Kaufman Fellows Academy, which is a VC program to learn how VCs work, how negotiations work. And 3 years ago, I've done VC Lab, which is a similar program by Founder Institute from the US. To basically also get an understanding how it works on a professional level. Let's put it that way. Okay. So that gives you a little bit of context why and why I'm sharing what I'm sharing. So first of all, for today, I want to talk a little bit about fundraising. Why do startups fundraise in the first place? Because to me, that's one of the major mistakes that a lot of entrepreneurs make in 9 out of 10 conversations that I have with them about fundraising. One of my first questions to entrepreneurs is always, why do you first of all run your business? Surprisingly, many entrepreneurs cannot answer that question. And my second question when I start about fundraising is, why do you want to fundraise? And a lot of entrepreneurs don't know why they want to fundraise, other than that they don't have money. I will tell you that is not a reason for an investor to give you money. Investors don't care. That's your problem, not theirs. So for a startup, I first want to start with what's actually a startup. So this is a definition from Steve Blank and Bob Dorff. You might have heard of these guys. They are a little bit of gurus from Stanford University and Silicon Valley. They wrote a really good book already a long time ago about what the difference is between a regular company and a startup. And they defined a startup as a temporary organization in search of a scalable, repeatable, profitable business model. Then they continue. The business model is a canvas covered with ideas and guesses, but it has no customers and minimal customer knowledge. So I've marked a couple of things here in this slide. One of the main things about a startup that's very different from all other companies is the scalable component. And that's important for when you start talking to your investor. Most companies in the world are not startups. Actually, only a very small fraction of companies are startups. Most companies that sell food, that do logistics, that do trade, that do building, whatever, they are a much, much, much bigger share of the overall economy. And the people who work there typically make decent money. Most rich people actually have built companies like that, not necessarily startups. But the big difference is that they're usually not very easily scalable. And by easily scalable, I mean that they can grow very, very much in a very short period of time. I mean, if you keep building a company for hundreds of years, everything is scalable. But the big difference is for startup, that a startup, because of usually the technology that it uses, it can scale up very, very rapidly in a matter of months. For example, what ChatGPT did last year, that's simply not possible for a restaurant chain. It cannot be done because of all the resources, the investment, the infrastructure that needs to be built. ChatGPT could grow to 100 million users within, I think it was 20 days or a little bit longer, simply because they were using technology. And because everybody was adopting it, there was basically no limitation to the speed that they could grow with. And that goes for all other huge startup successes as well, like Amazon, Facebook, etc. So that is the major thing that startups are different from other companies. Then you have to do something that's repeatable. I know from personal experience that's actually very hard. Like, it's very easy to come up with a platform that you can put on a server and that can run the same thing all the time. But very often a startup is like, the theory of the platform is not the same as the execution of the day-to-day running of that company. So, for example, what I'm doing right now is really badly repeatable because I need myself all the time to keep doing this, even though I have a platform. So then obviously it needs to be profitable. maybe not right now, but for sure in the future. To me, it's very simple. If you don't make money, it's a hobby. So you have to have a business model behind what you're doing. And then the second part of a startup is that you're starting with ideas and guesses. This is also very different from traditional business. If I start a restaurant in the center of whichever place that you guys are living in, I know that there's people who need food. That's not a guess. Like, I know that virtually anybody on the planet needs to eat 2 or 3 times a day. The only thing that I don't know for sure is maybe if my location is wrong or if my food is good or bad. But I know the market is there. So the idea is not new. It's more a matter of execution. For a startup, usually it's the other way around. The startups usually come up with something that is novel, new, in the market that they are in. I specifically want to put it that way. There's a lot of startups that don't come up with something that's new in general across the planet. That's almost never the case. Like, whenever a startup entrepreneur tells me that they have come up with something that's not been done before, I tell them you probably didn't do your homework. Or I put it a little bit more friendly, but that's the gist. So, because that's almost never the case. Like, it's very, 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 very rare to come across something that's never been done. That's almost only the case when something is being developed in university based on very complicated research. But all other things usually have been done, but usually not in that location, in that fashion, for that type of customer, in that way. So that's the difference. And because of that, you cannot leverage on knowledge from your own past and from other companies. Specifically for the Startup Buddy, when we started out with our online accelerator, basically I was explaining all the time what we were even doing. And I was based in Singapore, which is a startup hub, right? So this is not even a place where they have no clue about startups. But everything was done on offline in traditional accelerator programs, and software at the time was not a thing that was used for this at all. So then based on the idea that you have to start trying and testing and find out this works or this doesn't work. So usually what a startup does is start working on a minimum viable product. I'm not going to have the whole discussion about what an MVP exactly is, but high level, it's a prototype. It's not a prototype or a concept test. An MVP is designed to answer product design or technical, is not designed to answer product design or technical questions. Its goal is to test fundamental business hypotheses. So what this is saying, it's testing if there is at all demand and a market for the idea that you have. And ideally, this is tested really, really rapidly. So I started my company based on a hackathon called Startup Week in Singapore. And basically, during that hackathon, they really stressed to test during that 54 hours in that case, if our assumptions were right. And the simple way to do that is simply go out, ask friends, ask people in the street, ask anybody that you think is your potential customer, because you will find out that your hypothesis is wrong by definition. So an MVP does not have to be a technical superior product. Again, this is a wrong assumption of a lot of entrepreneurs. A lot of entrepreneurs start explaining when they pitch about why their product is better, faster, cheaper, whatever. First of all, most investors don't care, which I will explain later. You can have a really terrible product and still be a fantastic investment. So that's one. But secondly, investors are looking for what is the potential of what you're doing. And that does not need to be technically fantastic. But there needs to be a market for that. So that's why an MVP, like testing what you're working on, if there's really a market for it, is very important. So when you think you found your market, it's called product market fit. It's been coined a long time ago by this guy called Mark Andreessen that some of you might have heard of. By now, he's running together with his brother the biggest VC firm in the world, or second, depending on which website you believe. And he basically said product market fit means being in a good market with a product that can satisfy that market. Again, that's a pretty good definition, I would say. Something that I do, for example, in Singapore can work there fantastically. And I go across the border to Indonesia or Malaysia, and it doesn't work at all. The exact same thing. And that's very common. For example, because of language, like the startup body is purely in English. So anybody who doesn't speak English is very unlikely to use our platform to begin with. Then secondly, the startup body now has a gamified basically setup and user interface, and it also looks that way based on Minecraft design. I've already had a lot of remarks about that it doesn't look business-like enough. So depending who my customer is, I might be in the wrong or the right product market fit for my particular solution. So product market fit is making sure that whatever you do works where you are active, the market, the economy that you're in. Now, why are these two things relevant? Why I covered these first both? As long as you're working on your MVP, as long as you're working on assumptions and ideas, as long as you don't have product market fit, startups typically burn money. Meaning they don't earn anything or very little, but they are spending money on salaries, on running servers, on marketing, on travel, whatever. Any regular business, the moment you start, assuming that you pay yourself a salary, even if you're only by yourself, you have costs. And it's very simple. If you have costs and you don't have income, you have burn rate. So a startup usually has to develop something first and needs to bridge that period between the first revenue being able to come in and you in the same time spending money on whatever it needs to you need to spend on. So that is your burn rate. So that is why startups typically go into fundraising. For a restaurant, again, typically this doesn't apply. Normally, if you are not a horrible cook, the moment you open the door of your restaurant, you should be able to sell something. Maybe not profitable, but you should be able to sell something. So same for your clothes, same for a lot of other traditional stuff. But for all of you, like I heard last week what everybody is doing, as long as you have nothing working, you're basically stuck in pitching to your customers. Probably that already takes a lot of time, explaining them what to do. You will find out that your platform doesn't actually do what you need, so you keep investing on development, etc. All that period, you're not making money. And you need to find basically money for that. So that's why startups usually raise funding based on a little bit this kind of graph that's on my screen. And at the start of the graph, you see a depressing but very true effect, basically. Most startups don't make it past the starting stage, which is also called the valley of death, which is the stage that it's most difficult to raise funding. Why is it most difficult to raise funding? Because you're working on your MVP, on your product market fit. You don't have a product that you can easily sell yet. And fundraising, therefore, is very difficult too, because you're trying to convince people to give you money for something that you cannot actually sell yet. So that's why 9 out of 10. I'm not trying to depress all of you, by the way. I'm just trying to explain you how it works. But that's why 9 out of 10 startups fail. The good news is if you manage to get past that stage, you manage to get a product that you can actually scale, that your customers do start liking, it slowly becomes easier. You get other challenges, but definitely from a fundraising perspective, it becomes easier because you can showcase to an investor that you've survived this period. You can also show your track record that you have achieved up to there. So the risk of investment for an investor drops dramatically. and therefore it becomes easier to fundraise and to survive, basically. Then ideally, if all of us do well, so in 10 years we're going to do this session again, you should at some point be at Series F, or maybe even at an IPO. By then, all of you will have forgotten about me, because I'm one of the regular people and you've become Mark Zuckerberg. So please make sure that that happens. But that's basically what we're all trying to achieve. So then the fundraising process itself, I'm going to get in more detail on a technical, practical level later. But first, I want to explain the human part of fundraising. Because a lot of startups say, well, we're fundraising and we have a pitch deck, and then I get a lot of numbers, without actually figuring out who I am, for example, which to me is pretty important. So, and not just to me, but to any investor. So what I like to do is always compare fundraising to dating. I'm not sure how good all of you are in dating, so maybe I'm going to tell you stuff that you've never heard before. But let's say that you are in your 18s, which none of you are anymore, but you were 18 at some point. Maybe you used to go to a coffee shop, or to a bar, or to whatever. Basically, before you would go there, if you were looking to date with anybody, it would be a good idea to, for example, make sure that you had a shower, maybe put on some deodorant, maybe some makeup, maybe do your hair. Like, at least make sure that you look decent and are not repulsing whoever you meet. So that's step one. So that's the preparation. The same applies for your company. If you go into a meeting with an investor not being able to explain what you do, why should I even bother? And that's how it works in dating too, right? So then you have to make your approach. In dating, that would be, I think, for everybody the most challenging part. Striking up the first conversation, offering him or her a drink, coming up with a cool punchline, or whatever it is that works for you. Or going, sorry, I'm from past the dating app, so I've never actually done that. But I guess on dating apps, it's the same thing. Like, you like somebody, but you still have to come up with that first catchy message to make them react. So that's basically the approach. Again, it's the same for investors. I honestly get emails every day. Literally this morning, I was having a connection request from somebody that is asking me about the zero emissions fund that we're running, and he's running a chat app. To me, it's very simple. You didn't even bother to check what I do. And that means that chance is gone. I'm never going to contact that person again. Because if they cannot make the effort, I will not do that too. So then from there, you get into the pitching part. So there's always a lot of attention to the pitching part, which is explaining what your company is and why it's better and why it's the best opportunity, etc. That's basically where you start having a long conversation, hopefully for the night or for the next week, or maybe you're on the chat for 3 weeks before you meet in the first place. But now you're starting to exchange information between the two of you, with your date, or in this case, with the investor. If that conversation goes dead, in dating, typically you know what the message is. With investors, it's not much different. So if that conversation goes dead, that's a signal that it's probably not that great for them. And then when you get to the point that both of you are like seriously interested, then you get to do the due diligence part. Maybe now you start moving in together, or you get married, or whatever it is that you do in your relationship. But now you're really starting to invest and spend a lot of time to make this work. For investors, again, the same thing. It's usually when you start signing an NDA, when you have to open up your deal room documents to them and basically show you that whatever you've been telling them about your company is actually true. And then hopefully you get the money wired to your account. And then you get to a different stage, which I can tell you more about too. But then, at least from your perspective, fundraising, that first stage is check. So this is from a human level. please remember that this is at least as important as all the hard information that you're going to put in your deck. Investors will not invest in people that they don't feel a personal connection to. It's very simple. Typically, if an investor needs to invest in a startup, they do so with the assumption that this is going to be a success, because otherwise there's no point in doing it in the first place. And if the assumption it's a success, it also means it's going to be for the long run, because these investments are never for 1 to 3 months. They are at least 5 years or maybe 10 years. And very few people like working with people that they hate. So if that personal connection is not there, you're not going to raise funding on a human level. It has got nothing to do with your business. So keep that in mind. Okay, so now to the investors. I've already mentioned that a couple of times. There are a lot of different investors. And again, this you need to remember for when you start working on your fundraising. I feel you have to think first about who you want to fundraise from, and more importantly, why. And you need to have a rationale for that, and based on that, you make your pitch. So normally, your first fundraising round is from friends and family. These are the only people typically in the world who will give you money not for business reasons, but for all kinds of other reasons. They typically support you because they like you as a person, or they just want to support you in whatever it is that you do on a human level. A lot of them will assume they might lose their money forever, but they don't really care. It's about you, not about your business. So in that case, your pitch is probably not super important, like the content part of your pitch. But for the vast majority of startups, this is the main source of initial funding. There's one more that I have not put in the slides because it's not so much fundraising. But most fundraising is done by yourself. And personally, I'm very strict about that. What I mean by that is most startups, entrepreneurs start fundraising by putting in energy and money themselves first without getting it from outside sources. So this is called bootstrapping. Basically, yeah, you spend some of the resources, usually your time, for a while in your company to get to a certain stage before you go out to other people. I personally never invest in companies that don't bootstrap, because I feel that if you don't even think the idea is good enough to put your own energy and resources in, then why should I? It's as simple as that. So, and there can be different levels, of course, like how long you can afford to do that and things like that. All of that I get. But entrepreneurs who come up with an idea that they have not done anything for and go immediately to investors, to me, is always a warning light. Okay, then we have the angel investors. So angel investors are also typically investors at the first stages of your fundraising. Basically, angel investors are typically people with some money left over. I'm deliberately saying some money left over because it very much depends on the country that you're in, how much money that is. In many countries, investing is regulated very heavily. In other countries, it's not regulated or very little. And depending on that, an angel investor is defined differently. So in Singapore, for example, where the startup body is founded, officially to approach angel investors, they have to be high net worth individuals, which means that they are very rich because they have to have 2 million in liquid assets or 300,000 Singapore dollars in salary, which also in Singapore are rich people. Everybody thinks that everybody is rich in Singapore, but it's not like that. But in the Netherlands, for example, there is no definition of an angel investor. So in the Netherlands, anybody who's willing to put in $500 into your company can theoretically already be an angel investor. And depending on the country that you're in, $500 can be a lot or it can be a little. Yeah, Ahmed.
I have a quick question. Since we're talking right now about angel investors of the family, always question comes, okay, and that's what happened in my case. I'm more than happy to share. So my friend, but also he's a business angel in Singapore, said, okay, I will put 15,000 Singapore dollars. How much will give me shares? And then how would you help in that case? Because this is quite sensitive. So in my case, I gave 2.5%, but it was kind of very negotiable.
Yeah, so you're asking about the valuation. So that's I'm not going to cover that today, but it's a tricky topic. My short answer on valuation is your company is worth whatever anybody is willing to give for it. And for a lot of companies, that's zero, unfortunately. That's, again, not a very fun reality to hear, but if nobody is willing to pay for your company, the valuation is zero. Ideally, what you like to do, especially with your early investors, is come up with something that is fair. Now, what is fair? That's very flexible, obviously, because it depends on the situation. But in this case that you're describing, right? You have an angel investor. He was a friend, or she's a friend, or this is a random angel?
Yeah, friend. No, it's a friend. And whenever you started sharing right now, I just picture my story. Because it was much easier to approach, and they invested in me rather than the company, because they didn't know how it will go. They said, we just believe you. We hope that we at the end get our 15,000.
Yeah, but that's also a little bit the thing, right? At that stage, there is no valuation. It's purely a matter of give and take, and what that you feel is fair at that situation, and how much you appreciate that person putting money in. There are ways to calculate your valuation, and especially when you get to the VC stage, that will definitely happen, like discounts, cash flows, and things like that. I can go into that later. But when you effectively walk around with an idea that you don't have customers for, you have probably not even made a platform or an MVP or anything, the valuation is absolutely random. I feel that you, at that point, especially if it's a friend, you just have to come up with a number that you both feel comfortable with. And if 15,000 is a lot for your company, that I cannot say that for all of you, because everybody's in very different countries. Like $15,000 in Indonesia, you can run for a year, and $15,000 in Singapore, you can run for a month or two. So, but you basically, based on that, need to then decide, like, does it make sense 2, 3, 4, 5, 10%? It's weird to go past 10% that early in your company. And you should also never do that, because if your ambition is to long-term build a company and get more fundraising rounds, if you go above 10%, you make your future life very difficult because of other investors in follow-up rounds. So, does that sort of answer your question?
Yeah, thank you. Because the share is always a kind of sensitive question, because this is the only asset the company should have in the future, the valuable asset, and that's why.
Yeah, it's also why I said earlier, my first question to an entrepreneur is always, why are you building this company? The reason I ask that is, a lot of entrepreneurs are like, oh, I'm starting to give away equity to this guy. How much should I give? Very often that's a rationale from a very financial, I want to get rich in the future perspective. I'm generalizing, but that's usually the background behind you wanting to give 2, 3, or 4%. Entrepreneurs who are building their company because they have another reason, like a life experience or an ideological approach or whatever, very rarely ask this question. because they just want to make this company happen no matter what. So they don't actually care that much about the actual percentage. So for yourself, you need to determine that first. Why do you even get into this in the first place? So if you're fundraising at the first stage because you're really committed to this company, but you simply cannot sustain yourself bootstrapping, that means that you really, really need this money to make this happen. I think your percentage should be higher. That's what I mean by fair. But yeah, I cannot give you a number. That's the very short answer. Sorry, Abhijit?
Yeah, hi. So just quickly on the last statement that you mentioned, I understand the valuation or the percentage is something that's very negotiable, but doesn't like I've actually seen a lot of cases where people have gone forward and given a high amount of equity very early in their journey, especially as sweat or even like at a very low valuation, and that sorts of becomes like a death knell for them in the future. Like then nobody wants to invest because the previous rounds were horribly bad.
I'm going to answer this a little bit different. When I started my company, right, a big mistake that I made, at least for me personally, was reading too much startup media. And what I mean by that is when you read startup media, you read about fundraising rounds of other companies that you've never met. And that becomes very frustrating very fast when you are by yourself or with a small team in a room and you're wondering, why the hell am I not in that situation? What I realized a little bit later was that these people are in the press because they're usually the exception. Very often they are not the vast majority of entrepreneurs. They are the exception, and that's why they are in this media, and that's also why the media wants to cover them. Of course, companies that are hot and are wanted by investors can set the deal terms. It's as simple as that. Like Mark Zuckerberg still owns such huge part of his company because he happened to be one of those outliers that could basically tell anybody who wanted to join under what conditions that was going to happen. Unfortunately, I know very, very few entrepreneurs who that applies to as well. So that doesn't mean, and I know a lot of successful entrepreneurs from my point of view, right? Like Mark Zuckerberg is an outlier. He's the sixth richest guy in the world, I think. So that's not your average entrepreneur. So all the other entrepreneurs, it's on a scale. So if you're lucky, you're somewhere in the middle. You have a decent business. You can raise funding, but you have to also be good at negotiation, and you have to be good at your assessment of where your investors are from. And then you get let's say, an average deal. And then you have a lot of entrepreneurs who are at the bottom, who are scraping by, and who will take whatever dollar they can get. And that's very, very common. I know I'm not going to name the name, but there's a very, very successful company in Singapore by now that's expanded to Malaysia and Indonesia. They've been in business for 7 years. When I started working with them, they had their seed round. They had a cap table. For those who don't know, the cap table is where all your investors are listed. A cap table of angel and family and friend investors of 55 people. Now, the only reason that happens is because you're not able to raise the round the way you want. Because if you're able to just easily raise funding, you're going to get 2, maybe 3 investors. You're going to tell them, give me $1 million each. You're going to get 5% each, and that's it. And then you can go back to building your business. That, in theory, is what everybody wants. But the reality is that's very hard to actually make happen if you're not one of those very good companies. For all the other ones, my recommendation is determine first what you want. If you don't know what you want, it will never happen, in my opinion. I'm not saying that from a philosophical point of view. I'm saying that from an investor point of view. If you, for example, right, a lot of entrepreneurs cannot even explain to me why they're raising funding and what it's going to be for. That's, to me, a pretty basic question. Now, if you're coming to me and you're just telling me, okay, I need $100,000, it's pretty likely my next question is going to be, what are you going to spend that for? How long is that going to last for? If you don't know, that to me means that you don't really understand your own company. In reverse, if you do know exactly that you need $100,000 and that you're going to spend $25,000 on marketing because you've already run a Facebook campaign and a Google campaign in this and this market, so you have that baggage, all that knowledge already, and you can explain that to me in a very clear, etc. way, then we have a number. Then we have a number that we don't need to negotiate about anymore, because we both understand that this money is needed to get the company to the stage that we both want. That's important, right? An investor and an entrepreneur should have the same goal. If that's not the case, it's a mismatch anyway. So an investor will only invest in a company typically if he or she thinks that company is going to be successful, is going to be growing. So, and the investor knows that you need that money to do certain things. The burn rate that I was mentioning earlier. So if you can freeze that number that's necessary to get your company to that stage, that part of the discussion is gone. Then you can focus on what part of equity are we talking about, or what terms. Now, the reason that, for example, most early stage startups do convertible or safe notes, or I'm not going to talk about that today, by the way, so I can do that next week if you want, but the reason that usually early stage you do some kind of deal where you don't have to have a valuation is exactly because at the early stage you simply don't really know. That's why you kind of push that discussion for future. So I think you as an entrepreneur, and that's hopefully advice that you can, it all starts with you knowing what you want, what you need, and why. If those three things you don't know, then don't start pitching. Yes, Alan.
Thank you. Could you cover, not today, but in another session, what you see as businesses that have raised? I know every business is different, but how they allocate the money proportionally in terms of the focus. So whenever I've seen pitches and raises, there's always a smaller percentage that goes to marketing and a bigger percentage that goes to a team. Is there, not that I'm looking for a right or wrong, but what have you seen where teams that have come successful in the early round that allows them to grow successfully? Did I spend more on marketing? Did I spend less? I'm not looking for a secret sauce, but I'd love to have a conversation another time, not today, because I know we're short on time. But how have you seen the dollars being allocated for the money to be spent that gives a better opportunity of a successful outcome?
Yeah, so you guys are asking questions from different phases in the fundraising funnel. So maybe let me go back to that slide. If you look at this graph, right, this is a pretty typical graph for how a startup is supposed to develop over time. During the valley of death stage that everyone will go through, everything is pretty much random. The valuation is random, the money that you need is sort of random, because you're still working on the assumptions and ideas, the first slide that I had. And it's simply not possible to extrapolate based on assumptions and ideas. So at that stage, you're stuck with fair. What makes sense for the person willing to do business with me? What makes sense for me? And that's kind of what you need to do. And there's not a lot else to go on. Because of that, a lot of investors at that stage will also just give you fixed amounts for fixed terms. I'm not going to be able to cover everything that I wanted to cover for today, but you might have seen that another way of investment is accelerators and incubators and programs like Wasim and me are running with you right now. Programs like us, actually, this is one of the very few free programs that I'm aware of, but typically you go into a program like this and you give 5% of your equity. And that's equivalent to a amount that this program has decided upon. Now, you can have a lot of opinions about that, but the reason they do it like that is because these programs already know that it's almost impossible at this stage of your company to put a proper valuation on it. So that's very early stage. As soon as you start having some kind of traction for your company, I'm going to get into traction later, but ideally your traction is revenue, money coming in. But traction can be a lot of other things too. Can be signups, can be first registrations, can be likes on your Facebook, can be everything that shows that people are starting to pay attention to what you're doing. Is traction. That should, and now I'm answering your question, that should be the basis for where you're raising funding for. Because that you can start extrapolating. Basically, within Kobloom, there's probably 100 things that you're working on at any given moment. You know yourself probably pretty well which 60 things don't really work, which 40 things sort of work, and which 5 or 10 things do really, really well. With the investor, you should fundraise for those 5 or 10 things and the cost associated for that. So for some companies, right, like Berdis and I know that I'm really terrible at social media. I just don't really get it. So and because of that, I'm also not spending money on it because I usually do it wrong and it usually doesn't bring much. But there's other companies that are in exactly the same business as we are that are able to do this in a super successful way. So if they raise 90% of their funding for Facebook and Google ads, that makes sense. If I do the same, it's stupid. Okay, I'm looking at the time. I'm going way too slow. Yeah, so I want to, if it's okay with you, I want to finish the investors till the funds, and then we get to the funds next week. So like I already said, a very popular way of getting funding for your company is going through accelerators, incubators, or other types of programs like that. Now, sometimes you get real money in terms of direct investment, but that's actually, at the moment, I don't think there's any programs like that left anymore. A few years ago, there used to be, like they would give you a check for $10,000 or $15,000 as well. There are still a few programs that will pay you a salary for the period you're in that program, but also that's quite rare. But you can ask Wasim and me private. Running a program like this is pretty expensive. So that's basically the investment that accelerators and incubators put into you. So this is a way for a lot of companies to get off the ground, to start doing the right things, to building your network, and get a lot of maybe non-tangible or more tangible ways later on, getting into the investor connections, etc. So that's a very common way to get investment as well. Then there's governments. Wasim already mentioned this 2 weeks ago, I think it was. So in Bahrain, for example, Tamkeen is a government organization that spends a lot of money on promoting business and helping startups get off the ground. In Singapore, we have Enterprise Singapore, which has a lot of grants. Most richer countries have programs like this. And you should definitely look into that. Because if you're eligible, that's usually the best, quickest, and cheapest money you can get, at least in the markets that I'm aware of these programs. So, If you're not eligible, you're not eligible. So the difference here is it's not about how great your pitch is. It's about, do you tick all the boxes? So it's slightly different in that sense than most other ways of fundraising. Then very quickly, family offices. So I already mentioned that me and my wife have a small family office called the Zero Emissions Fund. We invest in climate tech and decarbonization companies. I say that very specifically. We don't invest in anything else. That's why I delete that email from that company that morning that's emailing me about a chat company. Like, if you send that to that email address, I either don't reply or reply very, very brief. Family offices are basically vehicles which are not totally professional, but basically on a more structural level, they keep investing in companies. Big family offices have their own teams. They even have employees doing investments for that particular family. Small family offices are like my wife and me. We do ad hoc investments based on what we come across, and we focus on something in particular. The difference between an angel and a family office is basically the amount of structure you put around it. Like an angel is very opportunistic typically. Sometimes they don't invest for 20 years and then they do 5. Family offices typically try to keep investing fairly regularly over a period of time. Then corporates, very important, depending on what sector you're in. For EdTech, unfortunately, corporates are not the greatest. But if you would be in fintech, for example, corporates are a very viable avenue to go. Most companies with 500 employees and more have some kind of investment arm. And these can have very different approaches, but most of the time, these investment arms invest in something that's related to the core business of the company they're connected to. So if they're in energy, they will invest in energy. If they're in finance, etc. It's very rare that they invest in something that's totally unrelated to their core business. Sorry, one more thing I want to mention about this. If you happen to be in contact with a corporate investor, from a business point of view, this can be super attractive because they can be your launching customer as well. So other than being a financial investor, having a big name behind you that is your launching customer and using that network can be ultra valuable. Having said that, working with corporates, different discussion for another time, is also very time consuming and difficult. So there's pros and cons. And very often, if you have a corporate investor, getting other investors can become more challenging because they don't always have a very good track record, corporate funds. For startups, banks are virtually never relevant. That's why I'm putting it almost at the end. So, but banks are the biggest investors in the world, financially speaking. So through loans, like traditional businesses typically build their companies through a loan. If you start a restaurant, typically you go to the bank first to get your loan. That's what you use to open up your restaurant. The difference is a traditional business can do that because they typically have some kind of collateral. So guarantee behind the loan, and that's why the bank will do that. As I've already explained at the start, startups typically don't have that. Your computer doesn't count as collateral for a loan. So there are rare cases where a startup can go to a bank when you, for example, want to do invoice lending but it's difficult. Most technology companies can typically not go to a bank in the first 5 years of their existence. And then finally, the funds. Because of the time, I'm not going to cover that for today. I'm going to cover that next week. So next week, I will explain more about private equity and VC funds, what the difference is. And that will also get me to the formal pitching that most of you are probably expecting to do. I think I took exactly an hour compared to when we started. Are there one or two urgent questions that you like me to cover for today? And by the way, if I cannot cover them today, just put them in the WhatsApp. I'll make sure to cover whatever is coming up next week.
I'll jump in with a question, Robin, or you can tell me to put it in the WhatsApp if you think it's going to be a long answer. How do you see when a pitch comes to you and they say they want to raise money, say $1 million, but they're going to use a portion of that to then apply for a grant to then top up that raise? Do you see that as a positive or a red flag, or does that create a whole set of questions or concerns for you?
Yes, for me it's the wrong way around. Get the grant first.
Okay.
So besides that, you're depending on, again, most first world countries, the VC, if you're talking about VCs, the VC is already leveraging on government support. So yeah, I don't know for your specific country how it works, but in Singapore, for example, most VCs, when they do a deal and they invest, for example, 1 million, depending on what industry you're in, they might already be able to get half of that million from the Singapore government. And they can usually not stack it. So they cannot use one grant to stack on another grant on another grant. So also from that perspective, it's not a great idea. Okay. If you, however, can do it the other way around, so in Germany, for example, I work with a lot of German companies, and in Germany, very often they first get government grants, and they use that to say to the investors, now your risk to invest is much lower. And that works really well, because if you use a grant to reduce my risk as an investor, that's great, of course. Anything else for today? Oh, sorry, I've never looked at the chat. Yes, I've heard about EduSpace. I know Alex pretty well.
I tried several times.
To get money from him?
No, not to get money, to be part of the incubation.
Ah, okay. I don't think that Alex actually invests. He says he does, but I've never actually seen him write a ticket. So he does work with a lot of other investors who do. So I hope to have Kais invest. I put it on the WhatsApp, right? So we already have 2 investors for demo day. We're working on a few more. There's a few EdTech specialized investors as well. So Kais Invest is, for example, famous from Baiju in India, which is a big tech company. So, but EduSpace itself, I don't think they invest. Okay. In that case, I'm aware I talked a lot. I hope it was useful and that I answered your questions. Like I said, we try to tailor the program a little bit around your needs. So today the valuation came up a lot. We also I also touched a little bit on different deal ways. So if there's other topics like that you want me to cover, then please let me know, because then I will prepare accordingly for next week. Okay. I'm going to end the recording now, and thanks a lot again, everybody, for today. And we see each other again here on next Wednesday.
Thank you. Thanks, Wasim. Thank you, Robin. Thank you.
Thank you very much.